Hey, welcome everyone. Tom here from Park Avenue Trading, and welcome to another installment of Lessons from a Chief Trader. Today, we're going to be discussing the all mystical Fibonacci levels. And what we're going to do here for you today is we're going to actually give you some ways that you could actually apply the Fibonacci ratios in a proper way. Please, if you like what you see, like, subscribe. Don't forget to ring the bell so you can get some really other cool stuff from me that I put out on technical indicators and trader mindset. So I have a client here, Ted, and he's here to put me on the hot seat and talk about Fibonacci. So go ahead, Ted. I leave it up to you.
Yeah, I was yesterday, day before. You called this trade in the trading room that I think we made 2 hour on it, but it was based. You said something like, kind of like Fibonacci, but not exactly.
Okay. The trade you're talking about happened on Monday. I don't remember when it happened because I started trading in the evening, actually Sunday night that was Monday morning for me in the States. And if you recall, the first trade that I took was not right. I actually
Yeah.
went long. I went long sterling yen, I think at 183.92. And I actually put on in the trading room that I had all these glorious ideas that, like, if it breaks 184.30, I'm pyramiding this trade. I'm getting bigger in this trade. I was so sure that thing was going to break and go up. It did not. And the best laid plans of mice and men, the market did not agree with me. It went up to 184.22, and I started realizing there was no velocity. And what I started to say was, okay, at 182, at 184.06, I took off half my position. And the idiot that I am, I should have realized when I said, I even put in the room, there's no velocity in this trade, so I'm going to move my stop to break even. The mistake that I made at that point was, since there was no velocity and I saw sellers at 184.22, I should have turned the trade around. I didn't. Why? I don't know. I could sit and second guess myself all day, but I didn't. However, I did take the short at 183.81, and I put my stop at 184, I think 33. And that trade took a while to get going, but once it got going, we were able to recover that trade at 183.09, very close to a Fibonacci ratio, and also what I call a trend reactionary number, and that's for another video. But I have my own proprietary levels, trend reactionary numbers, and we're not here to talk about those. We're here to talk about Fibonacci and the proper application of Fibonacci. And it's a very simple process. So you have any questions yourself about Fibonacci? I mean, should I talk about everything that you can Google about the guy? Leonardo da Pisa, basically became known as Fibonacci. He was a mathematician back in the day. Way I don't even, was it maybe 1395 or something like that? He was an Italian mathematician that came up with this sequence of numbers that when you add one to the other and divide by the other, you come up with a certain ratio that's only specific to that time series of numbers. Being an Italian Italian descent, I'm very proud of Leonardo di Pisa, or Leonardo Fibonacci. However, more research I did about him, he actually stole the idea from somebody else. And I hate to say it, but it's true. He actually took it from some Arab guy. The Arabs were working with this, and he was exposed to it, and he brought it to Italy. And Italy actually, of course, they had better marketing at that time. So he actually sold this idea as his. So it's a little stab to the Italian ego, but I got over it. So actually, what Fibonacci ratios are, that they're really used a lot in trading, and they're probably one of the first indicators that anybody that starts off in trading gets exposed to. They learn about this magic Fibonacci. Like, if I learn Fibonacci numbers, I'm going to be really successful in trading. I hate to say it, the number ratios are important, but they're not exact. And the point that I'm trying to get across to any trader, or novice trader, or a seasoned trader as well, is just don't believe that because you have the ratios up on the chart, that the ratios are going to hold. The ratios are there for you to gauge market momentum with, like anything else. The market is the total judge, jury, and executioner. That's it. Whatever the market's doing is what the market's doing, and the market's never wrong. It might not tell the truth on the instant, but it's generally not wrong. The whole idea of technical analysis is that trends persist. And you have to keep that in the back of your mind. If a marketplace has been going down and it breaks a certain level that everybody's thinking is support, well, the trend is probably going to persist and keep going in that direction. That's the whole idea with technical analysis, is that, okay, trends are my friend. I want to be part of the trend, And the old saying also is that a trend is your friend until it bends. It starts going the other way. So, I mean, it's Forex, trading, anything is wrought with double, everything is like just a contradiction at times, The point, Fibonacci, okay, just because you put the ratios on the chart doesn't mean that, think markets are going to hold there. The second most important thing is actually how to determine where you should place the ratios on the chart. That's more important than the chart itself. And we can go over that. I could take you to a chart. We could look at that buy and sell of the sterling yen that was on I think it was the 5th of January 2024. The trade was taken. All right, so let's talk about this trade. Okay, so yeah, so it's the 8th of January. Okay, let's go to the 1-hour chart. I very rarely trade really lower time frames. However, I do zoom in on the lower time frames to get a better entry. So I can't say I don't use lower time frames. I do. However, I use the 1-hour chart basically to get me in the main trend for the 1 hour, and I use the lower time frame to get me in a trade. Okay, so it was actually here. Let's go to the open of the trade. Okay, let's go to that open. This was the 8th. I said the 5th. I don't know what that came up with, but okay. So here was the open of the marketplace. I went long here at 183, like 92. Market rallied up to, if you see the high right there, 184.23, and then it crapped out. Okay. I gave a trade signal at 183.81. 82 is close enough, actually, to be perfect. I don't want people to think, oh, he's lying about 1 pip, I gave my trade signal there. Now, trade signal was a combination of a couple of different systems that I have. Genesis is my primary system. The Fib ratios I use basically to gauge market momentum. And I talk about that in Forex Confidant, where we're using Fib levels on trend line breaks to gauge market momentum. That is more important than actually the levels themselves, is gauging how strong the market is, okay, in that direction of that trade. Now, remember, this is very short-term trading. So I'm really interested in catching a multiple of my R value. And my R value here was like, so let's say it's looking at 183.90. It was like 43 pips was my risk. So what my 1R back is 43 pips. Okay. So, and look at this, like the market right now is at the trend reactionary number of 183.01 again, and also at the Fib level of 183.01 again. So since Monday, what's today, Wednesday, this marketplace has basically been staying in a range right now. If this breaks, most likely we're heading lower. Okay. But here we go. So what I did was I said, all right, on Monday, I have this high right here, and the market started to break down. So I basically said, in order to find proper Fibonacci ratios, what you do is, if you're working from a high, the opposite would be if you're working from a low. And I'll give an example of that in a moment. But let's just use this trade. I took this high here. I went to the left on the chart to find the last time it traded higher than this price. And that point was right there, 184.12. So this is a very tight market, okay? Because I'm working with Fibonacci on a 1 hour. You could do it on 4 hours. You could do it on dailies. You could do it on weeklies, however you want. It would all be the same procedure. You would work from what you got right now, go back in history and find a higher point, and then look for the lowest low in between those 2 points. This is the way bank traders do this. This is the way big hedge funds do it. This gives you an edge by actually seeing what they see. Because if you're just arbitrarily picking points to go retracements off of, you're not seeing what they see. You want to see what they see so you could basically make the same decisions they've been making. You're not any different than they are. Just because they work at a bank doesn't mean they're a genius. Believe me, I know. I worked at a bank. I am nowhere near a genius. So, and I make mistakes just like everybody else, like not going short when I saw no velocity. Okay. So you go to the left, you find the lowest low, and you actually, since this, I'm not really good with this fib tool, to be completely candid, because I don't really, I do everything by hand, the good old calculator, but I really should use this thing. But anyway, so I took the fib tool, I went from the low of the price in between the 2 points, and I ratcheted it up to that reference high. So this bar becomes my reference high. When I went short at 183.81, look how the fib level, actually, well, here was the open. The 0.82 level wasn't touched. Okay. The market came back down and it started trading lower, 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 lower. We came back down to 2.82 level. Now, 0.786 is the true Fibonacci ratio. I have changed it to 0.82. Why? Because 0.786, which is the square root of 0.618, I said there was a lot of skid through. The market always skidded through that price. What I found was 0.82 seemed to hold up better. So I just said, oh, I'm going to use 0.82. Well, why not? You know what I mean? So I use it. And 0.82 seems to work. So I would suggest that anybody that's watching the video, change your ratios to, instead of 0.786, make it 0.82 and put it on the chart, and you'll see that it's actually quite a bit better. It could be a couple of pips, but whatever it is, it is. Now, when the market came down to this, look at that, there's the breakout. When the market came down to 182, 183, I'm terrible with big figures, 183.02 level. There were 2 points that I was interested in there. One was my trend reactionary number at 183.02. I gave those numbers out on December 3rd, 2023. Okay, and I could show you, well, forget it, that's another video. But, and also the 2.82 level. Okay, so you say, all right, great, I got support here, or you supposedly have support. You don't know if it's going to hold, but how do I get involved in this trade? Do I just buy it? Some people would say yes, and they would go to the left and look at the lowest pivot right here and say, if I buy 183.06, I got to put a stop at 182.80. Not a bad risk reward. Okay, but you don't know if it's going to hold. Now, we know in hindsight that it did hold, but you can't rely on that. You got to act like at this market, you don't know what happened with this market. And let me tell you, if you're sitting here and the market is live, and I don't know why I can't move it over, and that's the only thing you see, you don't know if it's going to hold. So don't lie to yourself, because what happens is, like, when you start doing analysis in the, if this is a dead market, you could go, oh yeah, I could see that. I could see it going straight up. I would buy it there. Yeah, definitely. I would definitely buy it there. I'd buy 400 million there. Look at that. It went straight up to 184. Baloney. You can't do that to yourself. All right. But I'll give you a better way. Okay. Would I buy this straight up here? Yeah. Actually, I bought 183.09. I closed the trade out. I didn't reverse. That was another mistake. I didn't reverse the trade because I had good profit in it, but I didn't reverse it. And I'll tell you why I didn't reverse it. It was 4:50 a.m. New York time. My alert went off that it was by the rate price that I wanted. I closed it. I said, that's it. I'm going back to sleep. I'll deal, because the market's always there. I don't really care. The market's always there. There's always trades to be had. I just got to be patient when I come in to actually wait for the trade setup and take it. So what's another way of doing this? Let's just mark this price. And this is a cool little trick because it offers low risk and a decent reward. Okay. So I'm going to mark the bar that touched this price. This is the hour that it happened. And when you got the alert that you were down by that level, you would already know, like, okay, so this, you would move this over. I only put this bar here to give me an idea where this occurred. So anyway, market came down, bang, 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 bang. Okay, we're touching the point 282 level. The trend reactionary numbers here, that should add as support for us as well. All right, so how do I get involved? Do I just straight buy it? No, I mean, you could, like I said before, but what's a better way? Well, you have this bar that closes on a 10-minute. You could place an order to buy at the top of this bar, 183.15. Your stop loss could be 3 ticks below this bar, 183 the figure. You have a 15-tick R value, 15-tick risk. Will it work? I have no effing idea. I just know that this is a low risk trade. And you know what? If it doesn't work, I don't care. There's going to be another one right around the corner. Doesn't matter. It's no blow to my ego if it's wrong. Should be no blow to your ego if it's wrong. You're in the job of finding this thing. In trading, we deal in probabilities, not in certainties. So the probability that this is going to hold should be pretty good. Now, so we have a 15 tick R value. Market comes up, it breaks through, we're long, 183.21. Don't celebrate yet. We're not out of the woods. We're in it. It's good. Feels good. Hey, all right, maybe I got something here. What you really shouldn't do is say, I'm going to take my 10 ticks. I'm going to take him. Why? Why should you worry about money you didn't have before? Worry about money that's being taken from you in the market. Don't worry about money you didn't have before. This trade could be promising. This is where you should have all the hope in the world. Most people get hope reversed. They have hope that a bad position will turn good, but they fear a good position turning bad. Everything's reversed. You should have hope when the trade's working. And when you're in a bad trade, hope is not a strategy. It stands for having one position of extermination. That it's not a strategy. So anyway, so you got long because the market broke up through the high of this bar, and it starts tracking up. And lo and behold, you got 2R in the trade right here. You can immediately say, well, I'm moving my stop to entry, break even. Market continues, and it hits this point here. Sell. No, I wouldn't have known to sell there. That's a lie. What I see other people say is like, well, if you defined your risk at 15 ticks, well, you know what your profit is. That's bullshit. You don't know what your profit is. You never know what your reward is going to be. So don't limit yourself to, I made 15 ticks. I'm taking 15 ticks. No, you made 15 ticks. Hopefully it will move further in your direction. Maybe it will, maybe it won't, but you got to trade whereas the market is proving your position correct for the time being. You got to look for places to add to the position, and that's another video when we talk about how to add to a winner. But when the marketplace comes up here and hits this fib level of 0.618 off the whole shebang here, moving towards the top again, it starts coming off. At this point, you could place your stop at any fib level below to take a decent profit, and you would have been out. Does that make sense?
Yeah, that makes total sense. Yeah, you said like three or four things right in a row that were awesome. Risk management and how to use these to again, the sense of playing probability and not playing certainty. And the best traders are the ones that consistently stack high probabilities on top of each other, the ones that are going to win.
That's absolutely right. And the ones that stack the high probabilities that have the courage to add are the ones that win big.
So that's great. Yeah, thanks. Yeah, that makes a lot of sense of how to use Fibonacci and with a slight adjustment.
Slight adjustment, make sure that, you know, you follow the video. If you, if you're going to do the lows, it's exact opposite. You find the low, you go to the left. Last time it was lower than that price. What's the highest point in between? And do your ratios from those 2 points. So
Okay.
what you're doing is you're always keeping everything uniform. And you're not just applying randomness. Make sense?
Yeah, makes sense. All right, cool.
All right.
Thanks.
All right. So I want to thank everyone for coming and watching the video. Please, if you liked what you saw, hit the like button. Don't forget to ring the bell so that you can get other videos of importance by me. If you choose, please go to parkavenuetrading.com and pick up your free ebook, 3 Steps to Avoid False Breakouts, scientific way to look at fib levels, pivot points, trend lines. And I look forward to seeing you soon. Cheers, Tom.